No. Can you hear my voice? Am I audible? Oh, okay, fine. Okay, thank you. Okay then. Welcome you again to this particular class. And today I thought to take it a little bit late because of some other work. So anyway, thank you once again for joining. Now let us start with our today's class. So I think you can able to see my screen also. It is visible in your device that today what we are going to study or today what topic we are going to discuss about. So now this particular part is basically related to block 3 of your course. So you have 5 blocks. Out of that, second block we have already completed, and in second block we have discussed about process costing, operating costing, and apart from that we have basically looked after the reconciliation part, so in our last 3 classes. So today we are going to start up the block 3, and block 3 is basically related with analysis and interpretation of financial statements. So we are going to look over that what actually the financial statements are, or what do we mean by analysis and interpretation, and what are the various tools and techniques of analysis and interpretation of financial statements which are used in day-to-day business world. So we are going to discuss about all those things in this particular block. I will need 2 classes for this. Today I will take only the theoretical part. Today we will just only look over that what are the basic fundamental theoretical elements related to analysis and interpretation of financial statements. But in another class, which I will take on a later date, in that particular class, I will try to take up the different tools and techniques with practical problems, so that we can understand that how actually these tools and techniques are used and implemented, right? So let us start with our class today. Now, if we go for financial statement analysis, what the very first thing questions to our mind, or very first term which comes to our mind is the financial statement analysis, or analysis of financial statement. What does it mean? What is the basic point of financial statement analysis, or what do we mean by the analysis of financial statements? Now, before going for the understanding the word, before understanding the meaning of the word analysis of financial statements, we have to know what is financial statements. Now, whenever we are saying a financial statements basically reflects what? It reflects the true and fair view of the firm which has taken place in a particular year. Now, every business organizations, they are operating, they are working, they are doing their business. But where is the reflection of their business? What actually shows that actually that really the business is doing their job? Whether the business is really working their job or not? What statement or where it is reflected? Now, it is basically reflected in the books and accounts which is prepared by them. They used to prepare different types of books and accounts. Now, why these books and accounts are prepared? These books and accounts are actually reflecting that what work they are doing, or what work they have done in the last financial year. So, technically, whenever we are saying a financial statement, we are basically talking about the true and fair view of the work done by an organization in a financial year. So we used to call it as a financial statement. So these financial statements represents what? This represents the whole operational ability of the firm. This shows that how actually the firm has operated in a particular year, and whether their operations was perfect or not, whether they have done it efficiently or not. All those things could be reflected from financial statements. So when we are talking about financial statements, we basically understand 2 types of statements. The first statement is basically the income statement, so which is also known as profit and loss account, or we have studied that as trading account and profit and loss account. So what one is the income statement? So income statement basically it represents that what is the income earning ability, what is the profitability of the firm over a period of time, or over a period of 1 year. So, income statement is a statement which reflects the whole income generating ability of the firm in a particular year. The another statement, the second statement, which is also called as financial statements, or the part of financial statements, we generally called it as a position statement, and which is another name of that position statement is a balance sheet. So, the balance sheet reflects what? The balance sheet reflects the different types of assets and liabilities of the firm over a period of year. So a firm will definitely work with some assets and liabilities. There will be list of items in the firm which are classified as assets and liabilities. So we must have a place, or we must have a statement which reflects everything in one area, which shows that what are the different assets, what are the different liabilities, what are the long-term liabilities, what are the short-term liabilities, what are the third-party liabilities, what are the internal liabilities, what are fixed assets, what are current assets, all those things. So everything must be in one place. Every item must be reflected in one place. So the reflection of different type of assets and liabilities are basically shown in the balance sheet. And we know that balance sheets are often used to get tallied. That means assets side is always equals to the liabilities side, because the double entry rule system makes it equal. The fundamental rule of double entry system makes this particular equation equal at one point of time. So that is the beauty of the financial statements. But all of we, majority of us, or majority of the students who have studied commerce right from high secondary level, we know how to prepare trading account, profit and loss account, and balance sheet. And we have an idea that how we actually used to prepare the trading account, profit and loss account, and balance sheet. But the problem where lies? The problem lies that we know how to prepare trading account, profit and loss account, and balance sheet. But the question is that do we really know how to analyze these statements? Because preparing a statement and analyzing this statement in a such a way so that we can make decision is a totally different thing. Because if you teach anyone that how to prepare a trading account, profit and loss account, and balance sheet, anyone can prepare it. But just making it equal does not you can able to take a decision, because you are finding that suppose you have prepared a balance sheet, you found both the sides are equal. Is this sufficient? Is this okay? Both sides becomes equal and there is nothing more to do. Definitely not. There are more things to do. After that, the things becomes much more complicated. Why it becomes much more complicated after that? Because after that, the level of decision making comes up. And when we are talking about the decision making part, then definitely we have to look over that what information is telling us. What things are informed by the trading account, profit and loss account, and balance sheet to us. It is reflecting something to us, it is showing some information to us, how we can able to take decision on the basis of that, what will be our next step. We have prepared trading account, profit and loss account, and balance sheet, we got everything equal, our accounts are settled and solved, but what next step we are going to take, that will be totally depend upon these statements only. So that is where the need for analysis of financial statements required. So we know how to prepare financial statements, but majority of us don't know how to analyze the financial statements, how to make a study from the financial statements, how to find out information from the financial statements, the financial statements which we are regularly preparing, which we are seeing every day or on a regular interval. Now, in this case, basically, whenever we are talking about the financial statements, or whenever we are talking about, so that is what I'm sharing in this particular slide also, if you can able to see it, that financial statements are end products of an accounting process. So it's an end product of an accounting process. That means for 1 year, we used to record everything in one statement or everything in a statement. That is basically accounting process. It's a cycle, and for every year we used to do this activity, we continuously follow this particular activity, and these statements are prepared every year. What these statements are in giving information, this is giving information about profitability, this is giving information about financial position. So that is basically reflected by income statement and the balance sheet. Now, financial statements are what? Financial statements are the plain statements based on historical records, facts, and figures. So, what we find in financial statements? In financial statements, we generally find only records, facts, and figures. We have some numbers there, and we are recording those numbers on a particular sequence. Nothing more than that. These financial statements are nothing more than that. It's simply a plain statement which has some monetary figures, in fact, recorded in different places. So they are basically related to their objective nature and their behavior. They're based on that. What they reflect? They reflect a judicious combination of recorded facts, accounting principles, concepts, conventions, personal judgments, and sometimes estimates. Now, what is the point here? The point here is that the financial statements, it generally does not only show the figures, it generally does not only show the numbers. Financial statements definitely show us numbers, or we are looking over those numbers, but financial statements, it's not only just showing the numbers, it is also showing us the the hidden information. There are certain hidden things which are shown by the financial statements. What are those hidden informations? Like accounting principles, the rules which are applied in preparing the accounts, those are there, which is not visible to us. Suppose we are writing the wages in the debit side. So why we are writing the wages in the debit side? So obviously you will say that I am writing the wages in the debit side because it's a nominal account item. And what is the rule of nominal account? Debit all losses and expenses. So wages is an expenses. That's why I'm writing it on a debit side. Now that particular fundamental rule is nowhere mentioned. That fundamental rule is nowhere mentioned by anyone. You have not written that wages is a nominal account and that's why you are recording in a debit side. You have just recorded in the debit side. But why you have recorded in the debit side? That is the accounting principle, that is accounting concept, that is accounting convention, that is accounting rules, which is hidden in the financial statements. So sometimes our financial statements gets wrong because of what? The financial statements gets wrong not only just because of the numbers. The financial statement gets wrong because of the wrong application of accounting concepts, principles, and rules also. Most of us, because majority of you are students from the commerce background, so obviously all of you have an experience of, all of you have prepared trading account, profit and loss account, and balance sheet at one point of your lifetime. You have prepared it. Now it's a different issue whether you like to prepare it or not, whether you could able to solve it or not. That's a different issue, but you have attempted to prepare trading account, profit and loss account at one point of time in your commerce stream. Now every time whenever we solve a problem, every time do we get the answer correct? Do we get the answer correct? The answer means, do we get our trading account, profit and loss account, and balance sheet equal every time? Do we get it every time correct answer? No. No one can say that every time whenever I have solved a trading account, profit and loss account, and balance sheet, I have got every time I have got a correct answer. No one can say that. At least you have made mistakes somewhere. Every one of us, including me. So we make mistakes. Why we make mistakes there? We make mistakes not because that the question is wrong. Sometimes the question is also wrong, but majority of the time we assume that question is right. So irrespective of that particular factor, we make mistake. Why? Because we apply the accounting concepts and conventions wrongly into the problem, because we have a lack of idea about the accounting and concepts and conventions, that what rules to be applied, what fundamentals to be applied, where to record it, how to record it. Because as we don't know that particular part, that's why we make mistakes in preparing trading account, profit and loss account, and balance sheet. And finally what happens, the whole problem gets wrong. So our solving a particular problem is not dependent upon the correct information or the correct data. The solving a problem is also dependent upon what type of concepts, conventions, and regulations we are applying in order to solve that. So that is why actually accounting statements, it reflects lot many things. Accounting statement is just not the numbers. Accounting statement, it reflects many things which is hidden behind that. And that is where the whole idea of financial statement analysis is. That is the whole concept of analysis of financial statement analysis. Now, the process of critical evaluation of financial information contained in financial statement is to, in order to understand and make decisions regarding the operations of the firm, called financial statement analysis. Now, that is what I am saying from the very beginning, that why we are doing this. What is the basic idea of doing this scrutiny? Why we are postmortem this statement? We have prepared trading account, profit and loss account, balance sheet, and everything is equal. Fine. Do we close it and shut down? No. Even after preparing all the trading, profit and loss account, balance sheet, even the answer is correct, we have to look into it again and again. Why we have to look over? Because we have to see that whether we are really making some errors or whether we are missing something which is hidden there. So the financial statements are basically used to understand and make decisions. That's what the point is, because we have to take decisions for the future. Depending upon the today's and past information, we have to decide about tomorrow. What you will do tomorrow, that is totally depend upon what you are doing today and what you have done yesterday or day before yesterday or in the past. So your future course of action is totally dependent upon in your past and today's action. So if we don't scrutinize our past and present, we will not able to take any decision about the future. So similar concept is applied with financial statements. Our past and present is basically reflected by financial statements, but business is always future oriented. Business always likes to earn profit, definitely in present, but it has to be taken, the step has to be taken in for the future. So in that case, decision making becomes very important, and financial statements could be one of the parameters through which we can able to decide about the future. So it is basically a study of relationship between what? Various facts and figures, various financial facts and figures, and interpretation thereof to gain insight into the profitability. So we want to go into the statement, we go inside the financial statement and to know the profitability and operational efficiency of the firm, so that we can find out the financial health and the future prospects of the firm. Because see, every businessman whoever has invested money into the business, no one wants to lose his or her money. Even if you take yourself as an example, if you are doing a business and if you have invested 10 lakh rupees of money in that particular business, would you like to lose that money? Obviously not. No one would interested to lose the money. So if you don't want to lose the money, then definitely what steps you are going to take? So you are going to take some reactive steps. You will try to find out the information which is hidden so that you don't lose money in future. So your future steps will be totally depend upon your present analysis and interpretations. You have to look the financial statements in a very different way. And that is where the whole idea of analysis and interpretation of financial statements. The concept is that. Now, those students who are from accounting and finance, if you had a specialization in accounting and finance in your graduation level, probably you have studied a little bit about this. But those students who are not from accounting and finance background, or those who are from some other backgrounds in the graduation level, obviously you have missed out this particular topic in your graduation level. But those who are from accounting and finance background, they have touched this particular topic somewhat in their graduation level. So that's for the information, nothing more than that. Now, as the term financial analysis includes both analysis and interpretation, now these are the two different terms. Now, whenever we are saying analysis and interpretation, so we must understand that what is the difference between analysis and interpretation. So it's a totally two different terms. Don't make a mix things. Majority of the time, our students or we generally used to make a mistake that we assume that analysis and interpretation is the same point. It's not. It's totally different in nature. It's totally different. What analysis means? Analysis means simplification of financial data by methodical classification given in the financial statement. So we are making it simple. We are making it simple classification, simple interpretation of the figures. We are making it simple. We are making it simple. How we are classifying it? How we will classify? Classifying on the basis of nature, classifying on the basis of behavior, classifying on the basis of amount, classifying on the basis of type of expenses, type of income, like that. So we may make a simple classification of the items, because the financial statement is a very complex statement in a sense, because we must prepare trading account correctly, then only we can prepare profit and loss account. If then again profit and loss account should be correct, then only the balance sheet and balance sheet will go over. If then again in the balance sheet itself we have to record everything correctly, then only the things will become equal. So it's a complex statement. It is not that easy. But how we can able to make it simple for understanding purpose? So we can able to make it simple by classifying it in a different ways. Because in the asset side itself, if you look over a balance sheet and in the asset side itself, there are so many items. But why that asset side are sub-classified as fixed assets, current assets, investments? Why these are classified? These are classified because so that it becomes easier. it becomes easier for to understand that what are the fixed assets, what are the current assets, what are the owner's liabilities, what are the third party liabilities. That is the reason. But in our trading and profit and loss account, this classification is a bit difficult, because there again we have to look over lot many things. But what is the interpretation means? Interpretation means explaining the meaning and significance of the data. We have classified it, we have divided it, we have subdivided it. Now we have to make an interpretation. We have to try to find out information from there. Now if we try to find out information from there, then that is a complementary to each other. That means that shows that we are having some analysis and interpretation here. Let me take an example in this case, so that it becomes easier for you to understand that how actually the things work, or how it actually works out in a real life scenario, or in a real life world. Let us try to go with a, I'm just trying to take an example where we can able to do with everyone. Okay, I will take it in a different way. I will try to take it in a different way. Let us take it in this way. Let me go for a new slide. There I will try to understand. Now let us assume in this way. Suppose there is a sales. There is a sales. Now we generally used to have a sales. Suppose let us take 10 lakhs or 1 lakhs. So 1 lakhs amount is the sale, which figure which is actually showing in a definitely a income statement. Now after doing all the calculations, the gross profit, we got a gross profit. Let us assume the gross profit of rupees, suppose 30,000. Okay. And after doing again some calculations, we got a net profit of suppose rupees 15,000. Now this is the information. That's it. Someone will say that, okay, fine, the gross profit is 30,000 and net profit is 15,000. Now, if we convert it in terms of percentage, if we convert this equals to in terms of percentage, you will find this will be 30%. What does it 30%? Because the gross profit ratio, because it's a ratio analysis. If you go for a ratio analysis, then gross profit divided by sales equals to gross profit ratio. So gross profit ratio is what? 30,000 divided by 1 lakhs into 100. That is equals to 30%. So 30,000 divided by 1 lakhs into, so gross profit divided by sales into 100 equals to 30%. So that 30% is our gross profit. So what this information is showing? This information is showing us a information that that means if we sell 100 rupees item, we will get 30 rupees profit. This is a very vital information. Now, if you go for financial statement, this information is not shown in that way. It will show only gross profit, net profit. But when you are converting it in terms of percentage, and if you, because when we have converted it, it is analysis. But when we are taking a interpretation of this, what interpretation we are making? We are saying that means when I am selling 100 rupees item and I am getting 30 rupees, that means 30% means 30 rupees, means that is my gross profit, that is 30%, means by selling 100 rupees I am getting 30 rupees. That means 70 rupees is my expenses. That is a direct expenses. Now again, if we go for net profit ratio, if we go for the net profit ratio, what is the formula of net profit ratio? Net profit ratio says that net profit divided by sales. So net profit is what? 15,000 divided by again 1 lakhs into 100 equals to 15%. So that means again it shows that if we talk about not net profit, that means our 15% is our net profit. What does it mean? That means this is analysis. What will be the interpretation here? That means if I sell 100 rupees item, I will get 15 rupees as net profit. That is a actual profit of the firm. So that means before indirect expenses, our profit is 30%, 30 rupees. But after incurring some indirect expenses, we will get only 15 rupees. That is our. Now, this information, this particular information, this information is missing in financial statements. This information is missing in financial statements. The item which is in a red color, these are missing in the financial statements. These items are not shown in financial statements. Financial statements only show us sales, gross profit, net profit. That's it. But these items, the other things, what we have calculated, this is basically an analysis and interpretation. I'm just giving one simple example to you that how actually analysis and interpretation works. These things we will talk about in the later classes, because in the next class. So I'm not going with that right now. But to make you understand the difference between analysis and interpretation, how financial statements can show us some information. This is where we can able to work out. Now, these two items, analysis and interpretations, are complementary to each other. Complementary in a sense means you do analysis, but if you don't do interpretation, it makes no sense. You are doing interpretation, but you have done it without doing any analysis, then also it does not make any sense. So these two items, analysis and interpretations, are both the sides of a coin. Just like in a coin there is a head and tail, similarly for a proper decision making there should be analysis and interpretation. Now, analysis and interpretation of what? Analysis and interpretation of financial statements. So that is the necessity. Now, analysis is useless without interpretation, and interpretation without analysis is difficult. That is what I am saying right now. Now, financial statement is a process of identifying what? Financial strength, weaknesses of the firm. So why we are doing this? We are doing this to find out what are the positive sides of the firm, what are the negative sides of the firm. Because if you see financial statement, we cannot find out anything. But if we do the analysis and interpretation there, we can find out the positive and negative sides of the firm. So financial analysis or financial statement analysis, it helps us to find out the strength and weaknesses of the firm, and to make a proper relationship between the balance sheets and the profit and loss account. Because see, all these statements are interrelated. We know that these are interlinked. So when these are interlinked, any kind of problem in one statement is going to affect the other one also. It is going to create a problem for the other one also. So that is where actually we need to understand the influence of one statement on other. If we don't understand the basic chemistry between these statements, then obviously the analysis and interpretation becomes difficult. So we must have to understand the chemistry between these terms. We must have to look over that how these terms actually, or how these statements work together. Now, these statements or the analysis and interpretations are beneficial for various people. We will talk about that in another slide. We have that. Now, what are the objectives of financial statement analysis? What are the basic ideas, or what are the basic objectives? Why we do the financial statement? So, first things, as I am saying from the very beginning, to know about the earning and profitability capacity of the firm, because every business is earning profit. That's good. Now, as the example I have given, we have a sold 1 lakhs item, 30,000 is our profit. Fine. But when we convert it in terms of percentage, the information looks more familiar. The information looks more better to us. I will give one more very practical example to this. All of you have an experience of appearing exams. Throughout your life, you are appearing exams only, right from the day one you have attended your school. Now, every year you are appearing for some subjects, and you are getting some marks in each subject. How many of you remember those marks? How much marks you have got in English in metric, or in social science in class 10, or science in class 10? How many of you remember? I can assure you that majority of you have forgot that how much marks you have got in individually in each subject. I can assure you. Some of you may remember. I'm not saying that it's 100% true fact. Some of you may remember that how much marks you have got in mathematics, in science, or in social studies, or in language paper, or in English. Some of you remember. Some of you have forgotten, because definitely. But if I ask you that how much percentage you got in class 10, do you remember or not? Now you will find that half of the population remembers, or even I will say the majority of you remember that how much percentage you got in class 10. That means which one is more easier to remember? The percentage is more easier to remember, or the marks individually got in each subject is more easier to remember? Obviously the percentage is more easier to remember. But percentage is not actual reflection. Actual figure is totally different. But when we convert it into a percentage, it gives a totally different interpretation. That is where the logic behind the actual figure and the interpretation part. We convert it to some other figures. Percentage is nothing but it's a converted figure. Your actual figure is the actual marks what you have got in the subjects. But when we are asking that how much you got in class 10, you are saying the percentage only. You are not saying individual subject marks. So similar concept is applied in financial statements also. Anyway, so that's one example which I suddenly come to my mind. So what are the objectives? To know about the earning and profitability of the firm, to know about the operational efficiency. That means how efficiently the firm is operating. What is the operational efficiency? Because some information may be reflected there. Our operational efficiency may not be good. Though everything is showing perfect, the balance sheet, trading account showing perfect, but even then the operational efficiency may not be correct, may not be good. So through the help of financial statement analysis, we can know about that. Solvency of the business. Solvency basically means that how far the business will continue to operate. How far the business is going to operate without having any financial problem or burden. Whether we are in a safe zone or not, whether we are having too much of liabilities on our head, whether we have an asset, but whether those assets are basically useless assets. Majority of the things are useless assets. Is this the point? So we have to look over to the so solvency. We to know about the financial strength of the firm. To comparative study, because this is again an important one, because we are doing our business in a competitive in a competitive world. So it's not that you know your business, you must also know that how your competitors are doing the business. So you must know the competitors' business also perfectly. So for that you must have information about the competitors' business. So those, likewise, your competitor will also have your information. They will like to know about what you are doing. So they will look over your financial statements. So to know about the capability of payment of interest and dividend, all that things, to identify the trend, whether you are going in a right track or whether you are going in a wrong track, whether your business is going in a right direction, whether you are going in a wrong direction, what is the capacity of your business, whether it is working 100% capacity or whether it is working at minimum capacity or an average capacity, you must have some such kind of information. So those informations you will only come to know about from the financial statements. I will give in one more example. Suppose, let us take an example that in your financial statements you are earning profit of 30,000. You are earning profit of 30,000 by selling 1 lakh rupees of item. So obviously 70,000 is your expenses, and that 70,000 expenses you are paying majority of the amount as salaries. Suppose 60,000 you are paying salary. So that means out of 70,000, 60,000 you are paying salary. Now the question is that are you paying more to them, or your workers are working efficiently or not? Because in this particular problem, out of 1 lakhs, your profit is 30,000. That means remaining 70,000 is expenses. Out of that 70,000, 60,000 you are paying salary. So that means you are paying salary 60,000 to your workers, and by paying 60,000 to workers, they are selling only 1 lakh rupees of item. And 30,000 is the profit. But the question is that whether your worker is actually really working efficiently or they are not working efficiently. You would like to know about that. তুমি দৰমহা দি আছা কিন্তু তোমাৰ worker কামেই নকৰে, 2 ঘণ্টা 3 ঘণ্টা শুই থাকে অফিসত আহি পেলাই. Obviously your business will not earn profit. The profit figure should be more in that case. So you must have to know if these things, the information will show, the financial statements will show those figures because those are there in numbers. It will come up, it will reflect. So business people used to look over those clues in financial statements. They used to see those things. So to judge the efficiency of the management, to provide useful information. So these are the certain objectives with which we generally used to apply the concept of analysis of financial statement, or we used to analyze the financial statements, right? Now, what are the use of financial statements? So again, objectives and use, you can able to write it in a similar way. For taking investment decisions, obviously to take investment decision means what? Every businessman wants that his business should keep on growing. Every businessman wants that his business should expand. Every businessman would like to make the business bigger every day. But to make it bigger, to make it more viable, to make it more stronger, to make it more operative, the businessman have to invest money. But if the information is not positive, will the businessman will invest? Obviously not. So the investor, the businessman or the person who wants to invest the money to make the business bigger, he must get some additional information apart from financial statements. So for investment decisions itself, the businessman needs some informations. He must feel that, the businessman must feel that yes, by investing this amount I will get a profit. because an investment is totally a futuristic decision. It is not a decision for today or for past. It is futuristic because you will invest money today, but you are going to get the benefit of that money in future. So the question is that taking the risk, automatically risk comes there. Now, would you take a risk for a business which is not generating sufficient profit for you or which is not satisfying your expectations? Will you invest in that business? So obviously investment decisions are significantly influenced by financial statements. So obviously analysis comes there. Analysis have to be done there. Credit decisions. So when we want to sell something on credit or whether we are buying something on credit, so definitely that decision is affected because of financial statements. Too much of credit is also not good, but without having a credit also is not good, because if you do business without credit, you will lose the benefit of time value of money, or you will lose the benefit of money there, which is basically called as leverage analysis. Financial management or data term as a leverage analysis. So that benefit is lost. So sometimes credit used to give us the benefit. So that decision is required. Dividend decision, to distribute the profits amongst the owners, because in case of a companies there is no one single owner. There are many people who have invested money, basically equity shareholders. So obviously equity shareholders are any person who is having equity shares. They are the owners of the firm, so they have a right to earn profit from that. So dividend, they deserve dividend. So you must know that whether dividend should be paid out to them or not. To estimate the trend of the business, how the business is operating over the period of time, whether it is going in a right direction, whether it is going in a wrong direction, all those things can be decided with the help of financial statements. Managerial decisions, I'm saying already, I'm saying that for decision making, for futuristic decision making, we take these statements. Now, who are the parties involved in interested? Who are actually interested in financial statement analysis? If you look over everyone who is directly or indirectly associated with the business, they are interested in the financial statement analysis. But here I've just taken it a very specific way. Management, how management, why management needs financial statement analysis? To know the solvency, profitability, capital structure. Solvency means whether the firm is going to operate for a long term or not. They would like to know about that. Profitability, whether the firm is sufficiently profitable or not, so that they can maintain their business on a continuous way. Capital structure, what is the capital composition of the firm? How much equity capital, how much preference capital, how much debts and debentures? That ratio must be taken into consideration, because too much of debt is also not good, and too much of equity capital, investing everything from your own pocket, is also losing the benefit of leverage. So that is where the capital structure comes up. So financial analysis actually is helpful for the management in lot many ways, because the management are the people who are actually running the business, and those people, they need the information in a very accurate way, because otherwise if they get a wrong information, the whole management decision and management policies will be wrong, and obviously things will go wrong there. Investors, how investors are interested? They are interested in longevity, because they will invest the money. Investors like what? Banks, financial institutions, debtors, debenture holders. Those people are giving money to the company, so obviously they would like to know that when I am giving money to a company, suppose you have a company and I am an investor, why I will invest money in your company if I don't see anything positive? Or if I am a company, you are an investor, will you invest in my company blindly? Obviously no. It's your money. You will look over that whether it is profitable to invest in my company or not. So you will look for the information, you will look for different type of information, which helps you to know that whether my company is going to run for a longer period of time or not. What is my earning capacity? What are the future prospects? What future decisions and plans I have? How much dividend I am paying to the shareholders? Those things are very, very vital information for investors. Investors used to look over to those. Creditors are third party people, third party liabilities. They give either short term loans or long term loans. So they are interested about what? They are interested about liquidity, they are interested about interest paying capacity, the debt repayment ability. All those things they will look over. Every creditor, whoever has given something on loan to a company or to a firm, they will look over whether the firm can able to repay the money or not, whether the firm is capable enough to pay the interest or not, whether they are generating sufficient profit to pay interest or not. Government also likes to know about the taxes. Taxes part, because definitely government used to generate a huge taxes from these companies through taxation laws. So government is interested there, but they are all equally interested in production facilities or production abilities. They are interested about the employment opportunities because it's a futuristic decision. No government wants that the companies gets on closing down, because if the companies gets closing down, or if the companies keeps on closing down, the people will get unemployed, and if the people gets unemployed means there will be problem for the government in future. Definitely, I am talking it in terms of election issues, because in election the government will go out. So definitely, no government wants that their future election agendas are hampered. So they are indirectly they are not running the companies, but they are looking over the companies very carefully, that whether what the companies are doing, whether they are doing it in a proper way or not. Similarly, financial institutions for financial assistance, long-term solvency, profit earning abilities, these are the institutions which actually look over. They are interested in that. Employees are definitely internal members of the organizations. So why employees are interested? Employees are interested about the salaries, wages, bonus, commission, profitability. They look over. Because for a government employee, the government employee has nothing to lose because government will pay the money. But for a corporate sector, a person who is working in a company, he has everything to lose. Everything to lose in a sense means if the company is earning profit, he will get his salary, he will get his wages, he will get his bonus. If the company is going into drains, or if the company is starting incurring loss, he will lose his money. He will not even he will not able to get his salary also. That is what is going on in the Jagi Road paper mill. I think you know what is the issue with the paper mill in Jagi Road or paper mill in Kasar, Ashok paper mill. They are closed down. Employees are not getting salary because those are companies. Those are not government companies. Those are not run by the government. Those are the private sector companies. So they are not earning profit means what? The salary is lost there. They are not getting this is a very huge issue. So employees are interested into the performance of the companies very much. Capital market basically the share market or stock market, because definitely there the shares are traded there. The value of the company is basically looking taken into consideration. So obviously primary market, secondary market, those are affected because of these financial statements. Researchers, there are people who used to do research work, who used to see these data very minutely for understanding the overall performance of the economy, that how actually the whole economy or how the whole sector or how the whole industry is operating. So obviously researchers like to take the information from the financial statements. They collect the information from the financial statements. They collect the information of profitability, efficiency from the firm. So these are the informations which are helping the researchers to take decisions. Apart from these people, there are some other parties who are involved, like economists, those people who are who used to judge the performance of the whole economy, trade unions, news portals, news media, business news, and all that things. They are interested about financial performance. Competitors, as I have already told you, so and so forth. There are various people who are interested in financial. So overall, if you look over these two slides, you will find that almost everyone is interested in financial statements. It is not only the owners who are interested in financial statements. Apart from owners, the other parties who are directly or indirectly associated with the firm are also interested in the financial performance. And they used to do the financial statement analysis. So only preparing financial statement is not sufficient. We have to go beyond that, and that beyond work is basically the analysis and interpretation part. But there are some limitations of financial statements also. It's not that the financial statement analysis, now till now by looking over all these slides we can find out that okay fine, there are so many advantages of financial statements, so many people are interested, but it is not that. There are certain limitations of that. What are the limitations of that? The very first one is the scope of window dressing. Scope of window dressing means the way we show it, the way we want to show it to others. There is every chance of manipulating that figure, because the analysis of the analysis and interpretation is based on what? Financial statements. And the financial statements are prepared based on what? Based on the recorded data, fact and figures. Now if those fact and figures itself is wrong, if you make manipulation in the data itself, then obviously the financial statement will be wrong. Then the analysis and interpretation of financial statement will be automatically wrong. There is no use of that. It is just like a medical science. তোমাৰ ডক্টৰৰ নিচিনাকে তুমি ডক্টৰে তোমাক দৰৱ খাব দিলে, you went to a doctor, ডক্টৰে ক'লে যে আপুনি let me take it in this way. Suppose you had some problem with you. Suppose you are having some severe pain in your stomach. You went to a doctor. A doctor has said that okay, fine, you do some test. So you went to the diagnostic center, and in that diagnostic center, he has taken some blood. Now, the blood what he has taken insufficient blood. Suppose there is certain quantity they must take. Suppose someone inexperienced person has drawn the blood and he has taken less blood from you. Less blood in a sense means jiman lobo lagisle tatke kom lole. Now what happens with that, he has, and you came back to your home, he said that okay, you take the results. Now with that less blood only he has done the full result. So obviously jiman blood lagisile tatke kom bloodot he test to run korile obviously result beleg ulabo. So your whole report, the medical report will come wrong. That wrong medical report, you will take it to the doctor will see that medical report, and doctor will say that okay, you are having this problem, I am giving you this medicine, so now you are having that medicine. And that is where the question of wrong treatment automatically comes up. Means what? Because of one error at one step, the whole process gets affected. There is a scope is there also. If you make manipulation in the trading profit and loss data, primary data in journal entry and recording, তুমি এটা জিৰো বেছিকে লিখি দিলা, এটা জিৰো কমকে লিখি দিলা, তুমি চাবা you will find because of that the whole journal entry, trial balance, ledger, trading account, profit and loss balance sheet, everything is affected because of one extra zero. Finally, analysis and interpretation will also be wrong. That is what is window dressing. It does not reflect the price level changes. Obviously, these data are not basically information adjusted. So obviously, these are going to be affected, right? I think